Good afternoon. This is Tom Aspray with the Viper Report. It's Wednesday, July 28th. About 45 minutes left in the trading day. We're right in the middle of Fed Chair Powell's press conference. Doesn't look like the FOMC had too many surprises yet, but press conference is not over, so the markets are showing no strong reaction. In last week's contribution to Forbes.com, it was my suggestion that there still was time for a market vacation. In teaching clients and working with professionals as well as individual traders, I always advise them it's good to get away from the market sometimes. You can't do this 52 weeks a year. You're just more likely to make a mistake. And when you do get away from the markets, it really changes your perspective. And if you have the right tools, generally improves your performance. So that was my advice last weekend. It had been sort of a progression over the past couple weeks. Remember, in early June, we were very bullish, particularly on the solar stocks. The AD lines has just broken out to the upside. And but since then, July 11th, I showed reasons why I thought the stock market risk was increasing. We've had a couple of sharp declines since that post. And then after the last one, when the day traders rescued the market, I said, you really have to not worry about market corrections and learn to anticipate them and benefit from them. Market corrections, declines in a bull market or rallies in a bear market are just part of the normal market cycle. And if you see the signs and you're able to reduce your exposure prior to a correction, then you're well prepared for that correction. You're going to be buying when the correction's ending, which is often forecast in advance by the advanced decline analysis, as opposed to be getting stopped out of your long positions as the market sells off. So there were some interesting charts in both those articles you can find on Forbes.com. Of course, all my articles, if you search Forbes, Tom Aspray, you'll see all I've published since 2011. Today the market's holding up pretty well. As I said, this is about 10 after 3 Eastern time. And advanced decline numbers are positive. They've been kind of narrow for most of the day. They've improved in the last couple hours. 2120 up, 1154 down. You can see the S&P is sort of in a trading range. The Dow is down 105 points. NASDAQ Composite is up strong. S&P just up barely. So a mixed session. Nothing to get too excited about. I think we're going to see choppy action as we head into August with a downward bias. This chart is one of the reasons I think so. We have the New York Composite here. You can see the sharp break of support last week. This is the New York Composite, the broadest measure of stock markets, not made a new high. We're challenging the highs. We're up about 0.63% here, heading into the last hour of trading or so. But the market internals, had been making higher highs, throughout 2021. That started to change in early July. You can see we've made lower highs. We can still break this downtrend. Won't happen today, but it could happen in the next couple of days. If that's the case, and we're going back to those highs, but this is often a sign, the fact that we broke this support, that the market is getting tired. Even more relevant, if you see the stocks only, this encompasses all the issues in the New York Composite. This is the stock component, and you can see that it's formed significantly lower highs since early June. What has this happened? It probably is a result of the fact that some main big tech stocks, Apple, Microsoft, etc., are pushing the market higher, but the average stock is not doing that. And there's been lots of press about the earnings season. A lot of companies, last count, probably over 80% have beat estimates, but the markets so far has not really been impressed. Before the earnings seasons, several TV analysts were pumping up and pimping the big bank stocks, how great they were looking, how wonderful their earnings were going to be, and you should be in them. Well, here's the charts of 3 of them as of a few days ago. That was in the Forbes article, actually, the 23rd. You can see J.P. Morgan, great company, great earnings. If you base your investing on fundamentals, you have to realize that just because a company reports great earnings, that doesn't mean it's going to go up right then. In fact, it can you can have a downward slope in stock prices and an upward price in their earnings. That'll eventually be resolved, but certainly JP Morgan doesn't have a great looking chart right here. Wells Fargo, a little better, but still it's in a trading range. And Citicorp, even worse. So this week, of course, we have tech earnings. And as I pointed out in the article, it's been a great couple of months for growth. This is a ratio of IWF, that's the Russell 1000 Growth Index, versus the IWD, that's the value. Really helps you in your trading. It staged a major top way back in October, November. Value was outperforming. In June, I noted that there was signs of bottoming here. You can see the MACDs were looking bullish. So this has been the great spurt to the upside. Growth's now leading value. The sentiment on value in the past week or so in the financial media has gotten quite bearish. So the fact that that happens when you're reaching this resistance and big tech is reporting earnings, probably sets stage at least for a pullback. No real signs of a top. This cross has turned, or this ratio has turned lower so far this week. But, you'd like to see it break below the 20-day EMA and things before you really suggest that this rally is over. But it's something we concentrate to determine. We took most of our trading profits in the IWD in early June, whereas for investors, we're sticking with the IWD because it's still up a bunch since we recommended it last fall. Another reason I'm a little cautious on the tech sector is a bunch of the averages. This is the SMH, that's the Van Eck Vector Semiconductor. Everyone knows by now that there's a shortage of semiconductors, but really the semiconductor ETF has not made a new high, since early in the year. So this is a weekly chart. This bold line here is the pivot, so it's been above its pivot for all year, but it's been bumping into the R1 level, and though I don't think it's going to get back to the pivot, I'm interested in buying this if it gets down to the 210, 220 area, but not at these levels unless there's some signs of improvement from the technical studies. So that's why we're taking sort of a wait and see attitude. We've narrowed down most of our positions in the ETF and stocks, taken profits on strength, and fortunately so far the large declines we've had, the two sharp breaks, we haven't really been hurt by those, and that's probably due to the fact that we try to be risk adverse and get out of the market on strength as opposed to waiting till somebody pulls the plug. These are our current positions. We haven't updated the prices since last Friday, but consumer staples, the IWD we just talked about, it's got a 25% gain. We took some nice profits on our trading positions. XLV, we have the growth, the IWF, XLU, and GLD. GLD is not doing anything too exciting. Really needs to get about $1 or $2 higher to suggest that this pullback is over. As for stock traders, here are our current positions. On Monday, we put some orders out for Akamai and Cisco, partially filled here. Took some nice profits in PKI. We've been trading this one really well. We're still in Keys and Visa. We took half the profits on. It reported good earnings, but the stock is under pressure, and we haven't got stopped out, but we're going to probably raise the stop for Thursday's report. So if you're interested in specific advice for stocks, the Viper Hot Stocks Report, you just go to viperreport.com and you'll see a link. And if you have any questions, and of course you can find the Viper ETF at the same spot, and you can always email me at tom@viperreport. So I hope you've had a good week, and I hope you'll think about a market vacation and be safe. Thank you.